welcome you watching the Small and Mid Cap Show. I'm Mahima Vachrajani and with me is Harsh Saita.
Good having Mr. Kamlesh Gandhi, who's the Chairman Managing Director at Mass Financial Services. Welcome, sir. Always good having you and understanding perspective. Mr. Gandhi, just talk to us first off about growth. 23 odd % in Q1 FY25. Is it holding up? Are there certain segments, sectors which are growing better than others? Of course, you also got the benefit of 2 months post the Q1 numbers. How are trends playing out?
So good morning. Very rightly remarked by you that you have been a very consistent performer over more than 2 decades now. And we have always shared that we would like to grow anywhere between 20 to 25%. And I'm very happy to share with you that we have maintained that trajectory not over last few quarters, but at least over a decade now. Coming back to your point on how we see growth, I think Q2, we are also witnessing strong numbers in lines with our anticipated stated objective, that is to grow anywhere between 20 to 25%. And we are very confident of achieving that growth of anywhere between 20 to 25%.
Right. Mr. Gandhi, Mahima also joining in. I want to understand that you aim to double your AUM every 3 to 4 years. So I want to understand what are the kind of strategies and initiatives that you'll be taking to see this kind of growth.
See, we are putting our endeavors to be a diversified asset company. Having said that, currently 80% of our book comes from MSME, but we also have commercial vehicle, two-wheeler, and less than 10% of personal loans. So we are trying to see to that how we can be a diversified asset company and in our next phase of growth. As you know that we reached 10,000 crores last in 24 March. And as we embark our next phase of growth from 10 to 20,000 crores within next 3 to 4 years, we would like to be well diversified among all the products, withstanding the fact that MSME will be the major contributor to the overall asset growth.
All right, so you lean on MSME. I get that. Also, I want to try and understand, so you've spoken to us about product, talk to us about geography as well. You're well diversified, but there are certain states, pockets, geographies where you have lower presence. Are you penetrating deeper? Is that the goal, or you want to widen your reach within the places that you are at and not go deeper, just be where you are and just try and optimize? What's the strategy there?
So if you see, currently we are present in 9 states, including Delhi NCR. And the idea is to capitalize on all these 9 states and we'll try to have the demographic understanding of all the places where we are working and would like to penetrate deep in each of the states. And as we see it now, these 9 states will be sufficient for our next leg of growth. And we would like to replicate the Gujarat model where we have penetrated very deep. And we take our own time whenever we enter a new state. We take our own time to understand the demography, have the right set of people, have the right understanding of the products, and then grow. So I think we have spent sufficient time in South now, and we will be growing there within next 3 to 4 years, and we'll be penetrating in all the states which we are present right now in the way we have done it in Gujarat.
All right, Mr. Gandhi, you've reported a strong ROA of 2.8%, but I want to understand what's happening on the margin side. Going forward also, I want to understand what are your expectations with respect to margins?
So historically, we have been a company maintaining NIMs anywhere between 6.75 to 7.25%, depending upon the macro situation from time to time. So we see no reason that why we would not be in a position to maintain this NIM anywhere between 6.75 to 7.25%. And that will be sufficient to have a range bound ROAs of anywhere between 2.75 to 3%. So going forward, we are quite optimistic and confident that we'll be in a position to maintain our ROAs anywhere between 2.75 to 3%.
Understood. So ROA understood, but what happens with regard to margins if at all rates were to come off? Would the margin increase be temporary? How much of it gets passed on to the consumer? Just talk us through what happens in case of rate cuts.
See, according to our strategic intent, across cycles, whenever the rates have increased or decreased, as I shared with you, that the NIMs will remain range bound anywhere between 6.75 to 7.25%, presuming that we are getting a cost of benefit in the cost of funds by 0.25%. The NIMs will settle at the higher end of the spectrum, which I discussed with you, that it is at 7.25%. And in the times when the rates were higher, we were at the lower end of the spectrum at around 6.8 to 7%. So with the increase or the decrease in rate, the range bound NIMs will play out anywhere between 6.75 to 7.25%.
Hmm. Okay, and just to try and understand, right? Your the crux of the stability that the mass financial kind of brand brings is the asset quality. It kind of helps you grow at the 20 to 25% or gives you the confidence to grow at 20 to 25%. So I want to try and focus in on that. Uh, Asset quality in terms of your net and gross stage 3 pre-COVID was slightly lower. When you're looking at the graph, it's shifted upwards post-COVID. Not materially, but it's shifted upwards. Uh, where can we expect that? What's the reason for that? And do you believe that now stability will be there in terms of your issues?
See, the consistent growth of 20 to 25% is the cause and the effect. That the very fact that we have been in a position to maintain the quality is the approach to asset creation of growing at a very steady pace and not getting overexcited by the opportunities that the markets present. Now, coming to the GNPA and the NNPA ratios, we see this GNPA ratios to be range bound anywhere between 2.25% to 2.5%, depending upon the product mix that results into the various diversified products. And also the NNPA will be anywhere between 1.5 to 2%. So this will be our stated objective going forward.
Okay, Mr. Gandhi, I want to understand that you had raised 500 crores roughly via QIP in quarter one. So I want to understand that where are you going to put to use that kind of money that you've raised, whether it is geographical expansion or what is it going to be like?
So in lending business, capital is the lifeblood, and we have raised this money upfront for our next phase of growth. If I share with you, when we raised 500 crores, we were very well capitalized at 24% Tier 1 capital. But as we know that if you want to choose and pick the investors also, it requires a handful of time. So we are much way ahead of our time of the requirement as far as the capital is concerned. And this capital will be good enough for us for next 3 to 4 years. To be precise, till at least 20,000 crores. So that will strengthen the capital base.
Got it. Yeah, so it kind of gives you leverage with regard to capital. And does it also, therefore, bump up your NIMs a little bit, just the fact that you've done equity and not debt?
There will be a slight improvement on NIMs because of that, because 500 crores adding up, which is capital coming at zero cost. So that will add up slightly to the NIMs and overall profitability.
I want to talk to you about risk in SME especially. What gives you that kind of comfort? Of course, it's your track record as well, but what are you doing differently that gets you the kind of results in terms of asset quality in SME that it does?
So to be very candid, we don't do anything differently. But the only thing is that we follow a very simple concept of extending credit where it is due over all these years. My experience of 28 years tells that either lending can be a very simple business or you can make it as complicated as you want to make it. So if you stick to the dictum of extending credit where it is due, discovering growth at the marketplace rather than just determining growth, these are few of the strategies which has helped us to maintain the asset quality and at the same time grow at a very steady pace.
You've also grown two others. Sorry, you want? Sorry, I thought you were saying something. You've also grown two other segments of yours. When I'm looking at it, over the last year, you've doubled down on CV loans, and you've done salaried personal loans. So you're also getting into, in a sense, you're getting into pockets and segments which you haven't done earlier. Uh, is that possibly going to increase credit cost, and where is your credit cost guidance target? Is there something in your mind, sir?
Just to share with you, we are one of the oldest commercial vehicle financiers. When we were, the balance sheet size was small, we used to deal in three-wheelers and light commercial vehicles. So once we found the risk-adjusted returns dynamics favorable, we are refocusing on commercial vehicle financing. So commercial vehicle financing is nothing new to us, and so is PL. So we were doing PL on a very small scale, but to be also present on the consumption side of the economy, but within the range of not less than not more than 10% of our AUM. We have a strategy for distributing PL loans also. So both this segment, we are well versed with the segments. We are well aware about the dynamics of this segments. And when I talk about a GNPA range bound between 2.25 to 2.5% and an NPA between 1.5 to 2%, it factors all the products.
All right. Well, Mr. Gandhi, thank you so much for giving us those insights on mass financial, and thank you so much for taking out time and speaking with us at NDTV Profit.
Thank you. My pleasure.